What we're going to look at today is the difference between being self-employed and being a limited company. People ask me this question all the time, and I thought, okay, I'm just going to create a quick video so that you've just got an overview so you can see what the difference is. Now, this is more for UK people, so if you're in a different tax jurisdiction, check with your local authority there. So, in terms of being self-employed, the way it works here in the UK is you're going to have a list of sales, and I'm just going to use some easy numbers here. For example, say you had sales of £100. From that, you need to keep your expenses throughout the year, and we're just going to say, for the purposes of this, our expenses in this case are £20. Now, expenses that are allowable in the case of the UK are, things like postage, money you spend on advertising, say stationery. Any cost you incur in the course of doing business is a business expense. So just think, if you were working for some big corporation, some, say a supermarket like Boots, and you handed in your petty cash receipts to the person there, would they pay for your hairdresser bill? No, they wouldn't. So, that's not an allowable expense. That's got nothing to do with business. You have to look presentable anyway. So these are just purely things, you send a letter to a client, potential client, you've got the cost of the stamp, you're doing advertising to market your business, you've got stationery for your business, that kind of thing. So expenses incurred in the course of doing business is a business expense, and you need to be keeping your expenses together. And in the UK, tax year runs roughly from 6th of April to the 5th of April. So that's what we're looking at. So you keep your receipts that fall into those dates here, and the sales that you've made into those dates as well. So from that, what you're left with, when you take your sales minus your expenses, you're left with £80, let's say. Just trying to use some easy figures here. Now, on the £80, what you have to pay is tax and national insurance. And that comes in at roughly 20 and, say 13% respectively. So just for safety, let's just say 33%. So whenever, and this is really important to think about, whenever you make money, quote unquote, you've always got to be putting in, or putting to one side, should I say, 1/3. That's what you've got to think about to pay for the tax and national insurance, because what you don't want is to come to the end of the financial year and think, I haven't really set any money aside to be able to pay that. So I'm just going to get out my calculator and type in 80 times 33%. So that's approximately, in this case, £26.40. So in this case, that's what we'd pay, and it would mean we would be left with the difference, which is what we keep. So if you look at that as well, one thing to just bear in mind when you're running a business is that literally, you could have sales, and once everything's said and done and things like expenses and tax are paid for, you're literally left with half of the money that you bought in the first place. So just always bear that in mind as like a rough kind of guidance. And then in terms of when this information has to be filed, you have from the 5th of April, if you want the revenue to calculate your tax, to the 30th of September of the same year to get these figures into them, or if you do it yourself or get your accountant or someone to file on your behalf, you have until the 31st of January. So if we imagine that this was, just putting in a year so that you see it, say it was to the 5th of April, say 2013, you'd have until the 30th of September 2013 if you wanted the HMRC to calculate this for you. Otherwise, you have until the 31st of January 2014. So in essence, and this is a key thing to be thinking of, you could start your business in April 2012, but effectively not pay physically pay over any tax. This is just for the first year until the January 2014, so you've got quite a long time. But this is the thing about keeping 1/3, so that you don't go and spend all the money and realise at the end, oh my goodness, I've got a huge tax bill and I haven't really set any money aside. So that's self-employment. Okay, now just to have a brief look at being a limited company, because this is something people always seem to get confused with. So here's just a few key points about being a limited company. Your limited company year-end date can be any time, or rather can be at any month. And generally, if you started your company in let's just say May, and it doesn't matter what date in May, but generally the company's house just make your year end automatically be the 31st, or the last day of the month that it was formed. You can change the company year end date just by filling out a form with Companies House. Useful website for reference, companieshouse.gov.uk. And if you change the date, often, just for ease of use, sometimes people will make it to be the 31st of March, just so that it kind of coincides with this self-employment year end, because this is non-changing, this goes with the government year end. So that's the year ends dealt with, okay? The next thing to think about is, with a limited company, it works very much like this does up here. So you have sales, and then you have your expenses, which is allowable. And to be quite frank, you can use your company money and spend it on anything you like, but when it comes around to doing the corporation tax, all that will happen is any expense that you've spent that isn't a business expense just gets added back to the final figure. So this leaves you with a net profit here of £80. And so, for example, say part of that expense included, I don't know, some client entertaining, because that's not allowed, of, I'm just going to say £5, then basically at this point here, and this is for the corporation tax, you'd add back that £5, and that will make your net profit for corporation tax purposes be £85, and that is what you're going to pay corporation tax on. And corporation tax is approximately 20%. Just want to keep the figures nice and round. And so 20% of 85, just get out my calculator again, that's £17. And so what you're then left with is your net profit after tax, which is, let's have a look, 85 minus 17 equals £68. Now from this £68, that's out of which people can pay dividends, but, and this is the thing you have to sort of consider, one thing I just want to talk about here is wages and salaries. Now, if you employ staff, your staff expenses come under these expenses. If you're running a payroll or anything like that, that all comes under these expenses, which are all allowable. Now, if you're on your own payroll, that's fine. Your wage or salary would come out of this expense. However, some people, they don't run a payroll in order to pay themselves. Instead, they invoice the company. So them as an individual invoice the company. So when you do that, in this, on you as a company director, and I'm just assuming, and this is just, company directors, what they can do is they invoice the company. So this will then be an allowable expense. It might just call it consulting. But that company director would class that invoice as a sale on their self-assessment tax return. So invoice the company, that's what a company director might do. I'll just put this income is their sales on their self-assessment. The other thing to consider is just if you don't want to pay this corporation tax at 20%, one idea is when you get to this net profit of £68, or rather no, when you more get to this £85, at that point, and if you're a company director, you can invoice your company anytime you like, really. You might say, okay, company director will invoice the company £85 just at the end of the financial year. And the effect that this will then have on your limited company is that the effect is, if you have an allowable expense, 85, the net profit for the company is in effect nil. And then this 20% is avoided. However, as an individual, it would mean instead of 100, say, you might have 185, and so you end up paying tax and national insurance at 33% on your self-assessment tax return, and you just got to crunch some numbers and see if that makes sense for you. So that's the difference there. That's always a question I'm asked, like, what is the difference between having a limited company and, just being self-employed? The other thing is just very much in terms of paperwork, really, because when you're self-employed, you have a self-assessment, and that has a deadline date of, as we said, here, the 31st of January. That's the very latest it can be filed in, and you're paying tax and national insurance. However, with a limited company, there's more filing obligations, and so what you have is your annual deadline, which is 9 months after your year end. So if you have we'll say 31st of March year end, you need to get your things in by, let's just say, the 31st of December. You've got 9 months. And then in addition to filing your year end, and by that what I mean is you need a profit and loss account, and you need your balance sheet, and also just it's all done online anyway. It's like a director's kind of statement. All of that goes to Companies House. So you can file this online with companieshouse.gov.uk, get a username, password, authentication code. So you file those things at Companies House, and then, because all these government things are all linked now, the filing requirement with the HMRC, also known as the Government Gateway, you can also then use those figures that you've just filed there to also file your corporation tax return, and that has the same deadline, sort of 31st of December, and then that's done. So you pay that, that's done. And the only thing in addition for the limited company is that once a year you have a form which is, I think it costs about £13 if you file it online, and it's just a form, about 4 pages, nothing complicated, where you have to just state who are the directors, I think it's their name and date of birth and address, is there a company secretary, and I think there's a part of it for the share capital, called up share capital, and then it just wants to know what the SIC code, I believe it's called, and that is the sector industry. So if you're I don't know, if you're in the legal profession, I think there's a code for legal. There's, I don't know, about 100 different codes. So if you're an accountant, there's an accounting code in there, bookkeeping code, different codes in there. You just tick, and often with this kind of information, it doesn't really change that much, perhaps year to year, but it's just an annual filing fee on the anniversary of when you actually open the company that is required. And then the other thing just to remember with the limited company is that this information is open to the public, so you can go to HMRC, and sorry, not HMRC, to Companies House here, and purchase any information on any limited company in the UK. It's for a small nominal fee. It's all open, it's all out there. Whereas with a self-assessment, this is totally private, so no one can ever log in and see what figures that you've submitted for the self-assessment, but they can with the limited company, so that's just another thing. I think the other kind of thing with the limited company is people like the prestige to say, oh, I'm limited, but prestige out the window. There's a lot more compliance you've got to do on this side. And if you're a director of a company, they often require you to fill out a self-assessment as well anyway, so you end up doing them both because you're a director, I suppose. That is that for the video. Just in terms of the self-assessment though, one thing to bear in mind, in the UK, your allowable tax amount, what do they call it? Tax allowance. So allowable tax. This is the amount you can earn, amount each UK individual can earn tax-free. It changes year to year, and I believe in the tax year 2013-14 it's about 9,300. Now make sure, I don't know when you'll be watching this video, but www.hmrc.gov.uk and get the most up-to-date prices, sorry, not prices, rates on that website. It's very important. Likewise, companieshouse.gov.uk, check them out because they've got information on their site as well, as governmentgateway.gov.uk. But each individual can earn £9,300 roughly in this tax year 2013-14. So that is approximately 9,300 divided by 12. It's approximately £775 per month. So one way is also, if you have a limited company, you can also be, like we said here, as the company director, you could invoice the company £775 per month, just so that you're using up your tax-free allowance, so that your sales up here at the end of the year will come to 9,300, and you know that you're allowed that tax-free anyway. So once this amount has been used up, then your tax and national insurance is due on everything else. So just something else to bear in mind. That's the end of the presentation. Get in touch, www.booglsltd.com. You can email us, admin@booglsltd.com. What our really specialism is more in the bookkeeping. So when it comes to bookkeeping and payroll, really. So when it comes to these items here, particularly with receipts, expenses, don't get swamped down by them, but you do have to keep on top of them so that you're claiming everything that you're entitled to, in effect, making sure that you're making the most of your allowances and keeping this tax and national insurance, what you have to pay on the profit, to a minimum, a reasonable amount. It's no good spending lots and lots of expenses on things like, postage, stationery and cash, and then losing all the receipts. You've got to make sure that you've got a good system in place, you're keeping all your receipts, your books are up to date, and you know where you are as you go along. When you file, or if you file anything late, you end up with having to pay a fine. So having yourself in good working order avoids things like fines and penalties. So avoid fines and penalties. That's the end of the presentation. Thank you for your time.